Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's episode. Okay, the first question is from Yana. Yana writes, so chuffed, I think I've finally found a good enough reason to write into my favourite podcast. Thanks, Yana. My husband is 45. 210,000 salary, 300,000 in super. I'm 38, 158,000 in salary, 200,000 in super. Would love to significantly cut back work in 10 years' time. At the moment, we have no debt on our home, which is worth, say, 800,000. We have recently purchased an investment property in North Brisbane, 100% geared for 870,000. We also have 90% geared Hub24 high growth portfolio in a family trust of 480,000. We plan to keep adding funds to it, and about 160 cash in an offset account. I see strong value in using concessional super contributions for the tax savings and long-term compounding, mainly for my husband being older and in the top tax bracket. My husband prefers the flexibility outside super, worrying that he might not make it to 60 or may want to retire early. He has approximately 25,000 unused concessional contributions carried forward and will be aiming to keep him under the Div 293 threshold. Well, okay, the only way you can do that is by curtailing PRYG income, so you might end up having to decline a pay rise if you're able to do that, because don't forget it's on adjustable income, which adds back rental losses, these sorts of things. There's nothing you can do to actually avoid Div 293 tax, which, by the way, just for those listening, is the extra 15% you pay on super contributions if your adjusted taxable income is over 250,000. Anyway, I continue on. Yana writes, I feel we could have enough liquid assets in cash in Hub24 should we need it before meeting a condition of release. And I'm just trying to get my husband's head around how do we pay off our investment debts in the future. To me, it makes sense to put all our extra money into super in the coming years. What are your thoughts on this situation, and what would you do to optimize? I say, okay, so it's a really good question in terms of really ownership structure, but also keeping or maintaining a bit of flexibility. But I'm going to jump in and share a comment on something that you didn't even ask for. You said you've got a Hub24 high growth portfolio in a family trust that's 95% geared, and the portfolio is worth $480,000 at the moment. That's what Jana's said. So that means that the debt in the trust is about 455,000 and the assets are 480,000. Be really careful about gearing that heavily in a family trust. The reason for that is twofold. Firstly, if there's negative cash flow, so if the investment income is greater than the interest expense, you can't offset that loss against your personal income. It's trapped inside the trust and you've got to carry it forward. But moreover, the other concern is that if the trust incurs a taxable loss in a particular year, it loses any tax credits. So if you're getting imputation credits or foreign tax credits attached to dividends from your investments, and you almost certainly will, I don't know what you're investing in, but you're probably likely to receive those, you're going to lose them. So when I gear inside a family trust, I do it at a very low level, probably less than 50%. I certainly want to record a taxable profit in the trust each year. So I don't want to go in that loss position because I don't want to lose the negative gearing and also lose the tax credits. So that's just something to think about. Also, with respect to repaying the investment loan in this environment, for instance, in 15 years, when Yana's husband's 60, the trust portfolio, assuming in like a 7% return over the next 15 years, is going to be worth 1.3, and the debt's going to be still 455,000 or whatever it is today. That's not a big deal, right? The portfolio is going to be positive cash flow. That level of gearing is conservative. I actually don't think you really necessarily need to focus on repaying that loan. I think you just need to let time do its compounding and make sure that your investments are good quality and you're capturing those returns. Because obviously, if you can achieve a higher return, say 10% over the next 15 years, the portfolio is worth $2 million. And so the gearing rate's less than 25%. So I don't think you need to worry about reducing gearing. Now the question is, do you put more money into super or do you put more money into personal names? I think it just depends on how much cash flow you're talking about. And you haven't really told me, what your surplus investable cash flow is. But I would be probably a little bit more conservative given you're 38 and he's 45. So we're talking 15 to 22 years away from being able to access super. A lot can change over that time. And so I probably wouldn't want to lock it away. So sorry, Yana, I think I might lean towards agreeing with your husband and just accumulating more in the family trust. Remembering that we can gradually move it in through non-concessional contributions in the future anyway. And that's something I would be thinking about, but probably not for 5 to 7 years. In 5 to 7 years, your husband's sort of 50, 52. You start to then think, okay, what's going to change in the next 8 years? Probably easier to predict than the next 15 years. So I think I would prefer more flexibility, even if it's not perfectly tax effective. But it's not bad from a taxation perspective anyway, because you can always attach a corporate beneficiary to the family trust and distribute into that and cap your tax rate at 30%, but still get a credit for that tax. So then pay a dividend out when you are retired and you get that tax credit refunded. So it's not the end of the world. There's a bit of, time cost of money there, but it's not the end of the world. And I think I prefer flexibility over putting maybe too much money into super, particularly we have very little equity in your investment property. Really, the pool of, and you don't have a lot of equity in the trust either. So you really, if you look at all your investment assets, they're predominantly already inside super already. So you've got a bit of concentration risk there. I think I'd keep it outside. As I said, probably for the next 5 to 7 years at least. But thanks, Yana. It's a great question, and hopefully that commentary's helped you a little bit. Okay, next question is from Jane. And Jane, just a bit of a summary of her situation. 42, partner is 39, two boys, 7 and 4, 260,000 of income for Jane. Her partner earns about 400,000 that comes via a dividend because it owns 50% of a residential construction business. It goes through a family trust, but Jane doesn't get any of that because she's already at the top marginal rate. They have a permanent place of residence with 1.4 million mortgage with 2.2 value, and it will need to be renovated, which is going to cost 1 to 1.5. Two investment properties, one in Geelong West, double-fronted Victorian period home. Sounds like a great asset. Purchased for 835 in 23. It's valued at 1.1 now. So that's a pretty good start there for over a relatively short period of time. And I like the property. It shows that, I like the description. I don't know the details of the property, of course, but it's rare that I find people that buy property outside of a capital city actually do well, and that sounds like a good one. And they've got a pre-approval to buy in their next property, looking at sort of Yarraville, Williamstown area, spending 1 to 1.2. That doesn't sound like a bad idea as well. They've got 400,000 in combined super, 150 in offset, and 80,000 in shares and Bitcoin. Okay, here's the spanner in the works, so to speak, the terminology that Jane uses anyway. She's been offered a job overseas in the Middle East, in Saudi, earning 310 plus 100,000 bonus, a 410. That's tax-free. She says that she's going to become a non-tax resident of Australia, and my partner will remain an Australian tax resident and will fly back to Australia regularly. They're considering, what do they do? There's a bit of commentary there, but what do they do? What advice would you give? Okay, this is a really complex question. So if you're going to become a non-tax resident, you need to be really careful. Everyone needs to be careful in terms of decisions, advice, all those sorts of things. It is a really complex area. The first thing that I would deal with is, will you become a non-tax resident according to the ATO? And that's a really important question to ask, because the considerations you need to take into account are based on common law principles. So it's not very codified, this law, which means it's difficult to say for certain, that someone is a resident, someone is a non-resident. It's really based on the case law, the facts of individual situations. But you can bet your bottom dollar that the ATO is going to argue that you continue to be a resident. So you need to think about all the risks associated with that. And one of the key considerations is, and I quote, have you permanently severed ties with Australia? That's the key question they will consider. And when looking at that, they'll think about family here, travel to Australia, assets in Australia, all these sorts of things. Does it look like a temporary absence or is it a permanent absence? So you need to get some advice. I have seen some advice. I've got a client in a relatively similar situation, and he got some advice from a tax lawyer to say, no, we think there's a reasonably arguable position. Now, that terminology, reasonably arguable position, is worth pursuing because it means, per the law, that if the ATO comes knocking on your door and decides, actually, no, you are an Australian tax resident, you'll still have to pay the tax that you otherwise would have owed. You'll still probably have to pay interest on that tax, but you won't pay penalties. And that penalties could be 20 to 100%. So, avoiding penalties is, if you're going to fall foul of the law, is, important, but it doesn't guarantee, right? And the ATO is going to always argue the case that is going to raise the most amount of revenue. So that's the first thing you really need to think really, really carefully about. If you are a non-tax resident, the consequence associated with that is that you lose the main residence exemption for the period of time that you are a non-resident. So you're saying you'll be over there for 3 years. So 3 years, 50% of your PPOR, your primary place of residence, will incur capital gains tax. And also the time you are a non-resident, you will not be entitled to 50% of the 50% CGT discount. So really any growth, or at least proportionately growth that you have in property over that period of time, is taxed at the full rate, which means half of it's going to go in tax. So if I've got clients that may become non-tax residents in the future or will become non-tax residents, then I don't invest in property and I don't add property to their portfolio. So in your situation, Jane, you're contemplating a second investment property purchase. I guess if you do that, you might do that in your partner's name, not your name, or maybe not at all. I'd sort of trace it back to, how can we argue that you've permanently severed ties with Australia, yet your family, your children, your husband, your house, everything is back here. I guess that's the thing that you need to contemplate and get some advice on. So I don't know what I'd tell you to do, because it really depends on what argument we think we can make and whether you will be a tax resident or non-tax resident. Of course, the thing that's attracting you to the work overseas is the zero tax rate. Of course, I get it, but you just need to make sure you line your ducks up in a row to ensure that that's actually true. The last thing you want is to get an audit in 5 years' time and they get a tax bill for $1 million or $2 million or something like that. That's obviously not going to be ideal. So just be careful and get advice on that. And really anyone that's contemplating ever becoming a non-tax resident, that's an issue too. Okay, next question is from Rob. Rob writes, I'd like to ask a question about geared funds, internally geared funds, ETFs that is. I read this Morningstar article, which I'm not sure I understand. It says that although in theory geared funds will magnify gains, which are almost certain over a 10 plus year time frame, the gearing is distorted by day-to-day moves in the market and is not as simple as saying you'll come out in front using geared funds over a long time frame. Let's use GHHF as an example, please. If it is true that shares will be worth a lot more today in 10 years' time, then the same logic should apply to geared funds. Hopefully that makes sense. Yes, Rob, I think you're making sense. Look, it's a really good question, internally geared funds, ETFs. And I guess the first thing I would say is that we haven't seen how they behave in a significant... Oh, no, that's incorrect, actually. We had BetaShares has GGUS, which is a geared S&P 500 US fund, and it's got geared GEAR, which is a geared ASX 200 fund, and they've been around for a while. And we actually have seen how they performed in times of volatility, like March, April 2020 when COVID hit. God knows we don't want to remember those times. Anyway, so we have seen how they perform. I guess the thing with geared funds that you got to think about is that, yes, they magnify positive returns, but also magnify negative returns. They will also magnify, as a result, volatility. So they'll be a lot more volatile than investing in the share market. But you are bang on in that if you invest money in a geared fund today, and in 10 years, but certainly 20 years, you're going to achieve a much higher return as a result of that gearing than you would an ungeared fund. The volatility will be higher, definitely. As a result, the risk is higher, absolutely. But point to point, in terms of now versus 20 years' time, you'll be miles in front. Something we have been thinking about and talking about internally within our team. And we will use geared funds inside super and inside other portfolios for clients. That's almost certain, but we're not using them at the moment. But if we had a volatility event and the share market dropped 30%, for instance, absolutely we'd be having conversations about to what extent do we use these funds. And it's exactly what we have done as advisors ourselves. And this is sometimes the disconnect. And Campbell's going to write an excellent article. I haven't seen it yet, but the topic is excellent, and I'm sure he'll do an excellent job about the bias towards Australian share market, which is 1.7% of global developed economies in terms of its value. So why do we have 50% of our portfolios invested in the Australian share market? Well, I can tell you why. I can tell you the arguments that have been used to defend that position, which is universal across the industry. And there's a challenge here, right? If you're going to buck the trend in terms of industry, the regulator doesn't really like it. Like if everyone is putting if everyone's putting 30 or 40% in the Aussie market in their balanced or high growth or growth funds, and you do something different, you're opening yourself up to potential issues with the regulator and so forth. But putting that aside, because that doesn't worry us, we'll always do the best thing by clients. What is the thesis behind this? So anyway, I'm digressing away from geared funds, but I guess I'm saying that there's a conceptual wisdom out there. It doesn't always make sense, and we always have to test this. And we will definitely use geared funds. We're not using them at the moment, and certainly not when markets are all-time highs. I just think you've got to pick your point. And actually, remember now, I'm so old that I prattle on and forget about the point that I was going to make. The point that I was going to make is that, sometimes advisors manage their own portfolios slightly different than their clients, and you've got to ask why. Why is that? And we always ask ourselves why. And sometimes it's because we might have a different risk profile. Sometimes there's this legacy sort of ideas in planning about this is what a portfolio should look like. But I can tell you, most of the advisors in our office, including myself, have used these geared funds. I bought both GGUS and GEAR in 2020, in March 2020, when the market dropped. And so we will do that for our clients. And I think this brings up a bigger topic, which is what is the intellectual rigor around advice formulation and portfolio construction within the financial planning industry. And I think there's a bunch of things, not a lot, but there's a few, one or two things that I think stand out as wrong and should be tested. And, I think the industry could do better if it had a little bit more rigor towards it. Anyway, that's what we hope to provide to some degree in this podcast, is that intellectual rigor. And certainly Campbell's going to contribute to that next year. I think he's aiming to do that episode in February once everyone's back from the break. But it's a great question, Rob. And I guess, sometimes people have to look for things to write about and content and so forth, but I think those internally geared funds can play a really valuable role in portfolio construction. It is just making sure the entry point is the right time to use those funds. Okay, next question is from Philip. Really good one. I've got a question regarding land tax in New South Wales and holding property in a trust, which your readers might find interesting. I currently hold two properties personally, an apartment in Five Dock and a house in New South Wales. Of course, the house isn't going to attract land tax. I also have a trust which owns two properties, investment properties in other states. I recently purchased an apartment in Pyrmont, so we're talking about that's the fifth property, for $800,000, which I purchased under the trust. I have been hit with a land tax bill of $16,000. Whilst I think it's high and I need to call them to discuss the calculation, my understanding is that trusts have a very low land tax threshold in New South Wales. And if I had to purchase the property in my personal name, which I have a higher threshold, land tax might have been reduced or possibly eliminated. Is it worth transferring the property out of Pyrmont from the trust into my personal name? I understand that I'd likely pay stamp duty again, about $17,000. To do this, but in the long run, it might be cheaper than the reduction or elimination of land tax bills. Okay, it's a great question, Philip. So thanks for asking it. I wrote a blog on land tax back in 21. I don't have the podcast episode number, but if you want to find, this is what I do. To find, if I know I've written a blog about this, I need to find that blog. I just Google Pro Solution and then land tax, for instance. So pro solution and then the topic. So anyone that's going to make decisions like this, hopefully I've written a blog about it, and hopefully, sometimes blogs are a bit time sensitive. So you've got to be careful about reading something that I've written 5 years ago. It could have changed, particularly if it's a law or these sorts of things. So you've got to be careful. You can't just follow it verbatim. But maybe that's a little tip for listeners, that if they're going to do something, just see if I've written about it. Because Philip, I reckon if you read this blog that I wrote back in 21, you wouldn't have put it in the trust, because it's exactly what I talk about. And I've spoken about a few different times. And actually what I've done is financially compared, putting properties in personal name versus trust. In New South Wales, for example, you'll see some charts in that blog, and it would have been a no-brainer for you in terms of not doing that. You were right that in New South Wales, you don't get a land tax three threshold in a trust. That means you pay a rate of 1.6% on the land value of that asset, and that's why the land tax bill is so high. The tax-free threshold in New South Wales is over $1 million, which is pretty good compared to other states. So, and I don't recommend buying property inside trusts. Land tax is one of those things. The other one is negative gearing, depending on how much borrowings you've got in your structure, like in terms of your income structure. But that would be something to really think about. So now, is it worth transferring? Well, you said you have to pay stamp duty again. Absolutely. You quoted 17,000. I quote 30 to 31. I think it's going to cost you to move that asset outside of the trust, which is 2 years worth of land tax. So yeah, I would. I think, if you do the numbers, the payback period is going to be less than 2 years. And if you plan to hold that property for, say, 10, well, you're going to be miles in front, in which case then you would take the hit, put it down to a bit of a learning lesson and move it outside of the trust. Just be careful to everyone that is listening in terms of understanding how you own a particular property or asset, because it's an expensive, as Philip is learning, an expensive situation to correct. And, as I said, maybe Google my blogs or anyone's information. There should be a bit of information out there. I don't know if there is, but there should be. But thanks for your question, Philip, and sorry to hear that it's not an ideal situation to have to donate such a large amount of money through land tax to the state government. Hopefully you can find your way out of it, even if that means paying stamp duty again. Okay, next question is from James. A really good question. First up, love the podcast. Always first in the queue to drive to work. Well, hopefully it makes that drive, I was going to say a little bit less boring, but that sounds egotistical. Anyway, thanks for listening, James. I've listened to episode 367, which is the best super fund, 356, how to choose an investment option inside super, episode 342, which is the benefits of investing in property inside your super, are the benefits overstated? And finally, episode 326, part 2, pros and cons of using a wrap to invest your super. No wonder I'm tired writing so many blogs and podcasts. Okay, all this got me thinking, given the long time horizon of super, what about internally geared ETFs? It looks like Australian Super's Members Direct doesn't offer internally geared ETFs like GHHF or G200, for example. What about doing this within a wrap account or a self-managed super fund? I don't think you've explicitly covered this in your topic in your podcast. No, I haven't, and it's a great question. And I guess it's linked to really just the question I answered about internally geared funds and using them at certain periods of time. So the issue that you're going to have with internally geared funds, and really ETFs in general, is that a trustee has an obligation to set rules that relate to superannuation products to protect members to some degree from themselves. And so what you will find is every super fund, whether it's a wrap platform, super product, or a Aussie Super Member Direct, those sorts of things, they're always going to have limits. That is, you can put 20% into one ETF or no more than, a certain amount in different ETFs. They're going to, depending on kind of their perceived risk profile. So for someone that goes, you know what, I'm in my late 20s, I'm going to be investing in super for 30 plus, 3 plus decades. I'm going to put all my money in GHHF, for example. Even though the entry point today, just what I just talked about, entry point today is relatively high. Who cares? In 30 years' time, I'm going to be miles better off. And I think mathematically that is correct. The only way you're going to be able to do that is have full control over your asset allocation, is a self-managed super fund, because you are then the trustee of that self-managed super fund. So you then need to have documented investment strategy that is in line with the member's risk profile, and so that the onus of making sure those things are correct is on you, the trustee of that fund, not a trustee of Macquarie Wrap or Netwealth or so forth. So that's the way to get full control. And then you can put 100% in whatever you want, which is a double-edged sword, by the way, because if you don't know what you're doing or you're taking silly risks or those sorts of things, you've got to be careful. But for people that are confident they're going to make prudent, smart, evidence-based, logical, rules-based decisions, that's the best way to go. It'd be a really interesting exercise to actually financially model how much better off would you be if you're in your 20s and establish a self-managed super fund and invest in a geared ETF. I reckon you're going to be miles in front. And I reckon the fees associated with running a self-managed super fund, which are coming down, by the way, there's more technology and competition, those sorts of things. I reckon it's a really good option. And, if my sons listen to any of my advice, they don't, but if they do, I'd probably say, let's do that. And you've got yourself a really good super fund. But thanks, James. So that's, but I guess what you could do, and that's my criticism, I should say, with Australian Super Members Direct, is its investment menu is very limited and it's a cheaper style product. So it's probably always going to be very limited. So that's a concern. But if you went to Netwealth, for example, that has a very extensive menu, I don't know if those geared products are on their menu as an option. I bet they are. But even if you only put 20%, you put 20% in one of them and 20% in another, so 40% had internally geared, that's still better than no gearing. So I guess there is a slight workaround, not 100% gearing, but a slight workaround there that avoids having a self-managed super fund. Okay, I'm going to leave it there for today. Tomorrow, which is Christmas Eve, of course, I'm going to begin to share a 4-part series on what I've called wealth first principles. I think first principles with anything are always good to return to. They should really guide and underpin all our decisions. Plus also, if you are new to investing and financial planning and property and shares and super and all those sorts of things, it's good to start with first principles. So what I thought I'd do is publish a series of 4 podcasts over the sort of Christmas New Year period talking about these wealth first principles. And it would be a great reminder for experienced investors and hopefully a fantastic education exercise for new investors. And if you know any new investors, people that aren't already listening to the podcast, this would be, I would argue, a perfect entree into learning a little bit more and starting with some of these, really important first principles that underpin and should underpin a lot of financial decisions through our lives. So I'm going to kick off that series tomorrow, and there's 4 in that series, and I look forward to sharing that with you. And until then, bye for now. Before we wrap up, I've got a quick request. Apple and Spotify decide whether this show reaches you, and I never want to lose that connection. Email is the only channel I truly own. If you're comfortable, please leave me your email. I will not spam you. Each Wednesday, I'll send you one email with an update of new blogs, episodes, presentations, and videos that I've published. All content. Just visit investopoly.com.au/email to subscribe. Thanks a lot.